Look, you open your investment app and everything looks green. Your portfolio is up, maybe 5%, maybe 10% this year. You feel like you're doing the right thing. You're investing, you're being responsible, you're thinking long-term. But then, something strange happens. At the end of the month, you still feel broke. Your expenses are high, your savings don't grow the way you expected, and deep down you start asking yourself a question that doesn't make sense at first. If I'm investing, why am I not getting ahead? If that sounds familiar, this video is going to hit hard. My name is Nick, and I spend way too much time thinking about how people manage, lose, and misunderstand money. And if you're someone who is investing, trying to build wealth, but somehow still feels stuck financially, make sure to hit that subscribe button and give this video a thumbs up if this actually helps you out. Because here's the thing, investing alone does not make you richer. In fact, if you do it wrong, it can quietly make you poorer over time. And most people have no idea it's happening. Here's what most people don't realize. Your portfolio going up does not mean your wealth is growing. Let me explain. Let's say you invest $10,000, and after a year, it grows to $10,800. That's an 8% return. Sounds great, right? Now, adjust for inflation. In many countries, inflation is averaged between 3 and 8% in recent years, sometimes even higher depending on the category. That means your real return might not be 8%, it might be closer to 2%, or even negative.
Now subtract fees. Most investment platforms, funds, or advisors charge anywhere from 0.5% to 2% annually. That alone can cut your returns significantly. Then taxes. Capital gains taxes, dividend taxes. Depending on your country, you could lose another 10 to 30% of your gains. So that 8% return suddenly looks like this. 8% return minus 4% inflation minus 1% fees minus taxes. You're left with almost nothing. Or worse, negative real growth. This is where it gets really interesting. Because on paper, you're making money. But in reality, your purchasing power is shrinking. You're investing, but getting poorer. Now, you might be thinking, okay, but investing is still better than doing nothing. Yes, but only if it's done correctly. Because there's another layer most people ignore: behavior. According to Dalbar studies, the average investor significantly underperforms the market. While the S&P 500 might return around 8 to 10% annually over the long term, the average investor often gets closer to 3 to 4%. Why? Not because the market is bad, because people are. They buy when the market is high, they panic when it drops, they react emotionally, they chase trends, they follow hype. Let's break this down with a simple example. You invest $1,000 into a stock because it's trending. Everyone is talking about it. It goes up 20%. You feel smart, so you invest more, another $2,000. Then the market corrects. The stock drops 25%. Now you panic and sell. Your result? You didn't gain 20%. You lost money. This is the cycle. Buy high, sell low. And it happens more often than people think. Here's what most people don't realize. Investing is not just about what you buy. It's about how you behave. And behavior is driven by psychology. Let's talk about that. When your portfolio goes up, your brain releases dopamine. You feel rewarded. You associate risk with positive outcomes, so you take more risk. When your portfolio drops, your brain reacts to loss more strongly than gain. This is called loss aversion. Studies show that losses feel about twice as painful as gains feel good. So what do? You avoid pain. You sell. Exactly when you shouldn't. Now combine that with constant access to your portfolio. You check your app every day, sometimes every hour. Every fluctuation feels important, but in reality, it's noise. Markets move daily, sometimes randomly, but your brain treats it like a threat, so you react. and every reaction costs you money. Now let's layer in another mistake: overcomplication. Most people think more investments equals better strategy. So they buy multiple stocks, crypto, maybe some funds, maybe something they saw on social media. Their portfolio becomes a mess. No structure, no strategy, no clear goal, just random assets. This creates a false sense of diversification. But in reality, it's just chaos. And chaos leads to poor decisions. Because when you don't understand what you own, you panic faster. Now compare that to how disciplined investors operate. They don't chase, they don't guess, they don't try to outsmart the market. They build simple systems. And this is where everything changes. Instead of trying to win every trade, they focus on consistency. Instead of timing the market, they stay in the market. Instead of reacting, they automate. Let's talk about the simplest and most effective strategy most people ignore: dollar cost averaging. Here's how it works. You invest a fixed amount regularly, regardless of market conditions. Let's say $500 per month. When prices are high, you buy fewer shares. When prices are low, you buy more. Over time, your average cost balances out. And more importantly, you remove emotion from the process. No timing, no testing, no stress, just consistency. Now let's put numbers on this. If you invest $500 per month for 20 years at an average return of 8%, you end up with around $300,000. Not from timing, not from picking the perfect stock, from consistency. Now imagine instead you try to time the market and miss just the 10 best days over that period. Your returns can drop by more than half. That's not a small mistake. That's cataclysmic. This is why behavior matters more than strategy. Now let's talk about another silent killer: fees. A 1% annual fee might sound small, but over 30 years, it can reduce your total returns by hundreds of thousands of dollars. For example, $100,000 invested at 8% for 30 years equals about $1 million. Same investment with a 1% fee equals around $760,000. You lose $240,000 from 1%. That's not a fee, that's a leak, and most people don't even notice it. Now combine all of this: inflation, fees, taxes, bad timing, emotional decisions, and suddenly investing becomes less powerful unless you fix the system. So what actually works? Let's simplify everything. Step 1. Stop trying to beat the market. Statistically, most people fail. Even professionals struggle. So instead, capture the market. Low-cost index funds, broad exposure, minimal fees. Step 2. Automate your investments. Remove decision-making. Set it once, let it run. Step 3. Reduce friction. The harder it is to access your investment money, the less likely you are to mess with it. Step 4. Increase contributions over time. Not your risk, your input. This is key. Wealth is built more from how much you invest than how perfectly you invest. Step 5. Think long-term. Not months, not even years, decades. Because compounding needs time. And this is where it all connects. Most people focus on returns. Wealthy people focus on systems. Returns are unpredictable. Systems are controllable. And control is everything. Now you might be thinking, this sounds simple. Yes, that's the point. Simple works. Complex fails. Because complexity increases mistakes. And mistakes cost money. So if you feel like you're investing but not moving forward, it's not because investing doesn't work. It's because your system is broken. Fix the system, and everything changes. Because at the end of the day, wealth is not built by chasing gains. It's built by avoiding losses, controlling behavior, and staying consistent long enough for compounding to do its job. And most people never get there. Not because they can't, but because they overcomplicate, overreact, and underestimate time. Don't be most people. Build the system, stick to it, and let the math work.